Suppose a stock falls 50% on Monday, and then rises 50% on Tuesday. Are you back to where you started? Most people say yes. The answer is no, you are down 25%. And the reason that gap exists tells you almost everything you need to know about how to measure returns correctly. Let's build this from scratch. A return measures how much your investment grew or shrank over one period. Here we only care about the move from 98 to 105. The price moves from 98 to 105, so the raw change is 7. Now the key question is, 7 relative to what base? The answer is the starting price, 98, because return is a percentage of where you began. That denominator is doing real work. £7 on a £98 base is about 7.14%. The same £7 move on a £1,000 base would be only 0.7%. That is why the formula is change divided by starting price. Written in symbols, the simple return R equals P_T minus P_T minus 1, divided by P_T minus 1. This is exactly a percentage change. Now back to Monday and Tuesday. The stock starts at 100. A 50% fall brings it to 50. A 50% rise on 50 brings it to 75. The 2-day return is not minus 50 plus 50 equals 0. Simple returns do not add across time. They multiply through compounding. The correct 2-day return is 1 minus 0.50 times 1 plus 0.50 minus 1, which gives minus 25%. And the reason is that each period is applied to a different base. The 50% rise is applied to 50, not to 100. There is a form of return that does add cleanly across time, the log return. It is defined as the natural logarithm of the price ratio. Why that formula? Because across time, price ratios multiply. Monday contributes 50 over 100. Tuesday contributes 75 over 50. Multiply them and you recover the full 2-day ratio, 75 over 100. That is the whole reason the log formula exists. The logarithm turns multiplication into addition. So ln of 75 over 100 becomes ln of 75 over 50, plus ln of 50 over 100. Numerically, that is plus 0.405 plus minus 0.693, which equals minus 0.288. And that exactly matches ln of 75 over 100. Log returns also fix a symmetry problem that simple returns have. A 100% simple return doubles your money. To lose that gain, you need a 50% drop, not another 100% drop. The two moves are not mirror images. In log return space, doubling your money is plus ln, 2, approximately 0.693. Losing that gain is minus ln, 2, approximately 0.693. Equal and opposite, as you'd want. Now here is the practical bridge between the two definitions. For small returns, say, less than 5%, the log return is approximately equal to the simple return. ln, 1 plus r, is very close to r when r is small. This is why you will sometimes see them used interchangeably in the literature for daily data. But for large moves, earnings surprises, market crashes, they diverge, and the log form is the one you should trust. There are 3 reasons quants prefer log returns, and they reinforce each other. First, time additivity. You can sum log returns across days to get the period return, making aggregation trivial. Second, normality. When you model prices with a log normal process, the standard assumption in options pricing, the log returns are the thing that is normally distributed. Summing them connects naturally to the central limit theorem. Third, symmetry. A 50% loss and a 100% gain are not comparable in simple return space. In log return space, both equal roughly 0.693 in magnitude. This matters whenever you are running statistics, building models, or comparing strategies, which is to say, almost always. Log returns are not perfect. They assume prices are positive, which is true for equities, but failed spectacularly for oil futures in April 2020 when WTI briefly traded at negative prices. They also assume continuous compounding, which is a mathematical idealization. Real markets trade at discrete intervals. And for very short holding periods, intraday or tick data, even the approximation ln, 1 plus r, is almost equal to or breaks down if individual moves are large. The log return framework is a powerful simplification, not a law of nature. Know the regime you are in before choosing which form to use. So now you have a return series, a sequence of numbers, one per day, measuring how the price moved. The next question almost asks itself, how much do those numbers jump around? Some return series are calm, prices drift gently up or down. Others are violent, large swings in both directions. What is the right way to measure that randomness, and what does its magnitude tell you about the asset? That is the question we answer next. Thanks for watching. You now know why quants measure returns in log form, and why that single algebraic choice makes nearly everything else in quantitative finance cleaner. If you want to know what to do with a return series next, how to measure how wildly it moves, Episode 2 builds volatility from scratch. See you there.